Today, we're doing a deep dive into the latest financial report from a company called Powermatic Data Systems. Now, they've been a tech company for a long time, but their newest numbers, well, they tell a really fascinating story about a big strategic change that you might not see coming. So the very first thing that just jumps off the page is this number right here, negative 27%. That's how much the company's net profit dropped in the last 6 months compared to the same time last year. A dip like that for any company is a huge headline. It's the kind of number that makes investors really sit up and pay attention. So yeah, the immediate question is pretty obvious. When a tech company's profit falls by more than a quarter, should you be worried? I mean, on the surface, it definitely looks concerning. But as we're about to see by digging into their own report, the full story here is way more complex and, frankly, a lot more interesting than just this one number.
Okay, so here's how we're going to break this all down. We'll start with those headline numbers, then we'll dig into what's causing the slowdown in their main wireless business. After that, we're going to uncover this massive pivot they're making into real estate, check on their overall financial health, and then finally, see what the company itself is saying about the future.
All right, let's jump into Section 1, the headline performance. Let's take a closer look at the numbers that gave us that initial 27% drop. So this table really lays out the challenge pretty clearly. Revenue, that's the total cash coming in from sales, it fell by 18%, from about 7.5 million down to 6.1 million Singapore dollars. And like we saw, net profit, the money that's left after all the bills are paid, it dropped even harder by 27%. This really sets up the core mystery we need to solve. Why is a company that's been in the wireless tech game since 1989 all of a sudden seeing such a steep decline? And this, right here, gets to the absolute heart of it. To really understand Powermatic right now, you have to think of it as two different companies operating under one roof. First, you've got the story of their traditional tech business, which is, facing some headwinds. And then you've got the story of this huge, brand new bet they're making on property development. These two parallel stories explain everything. So let's tackle that first story, the slowdown in their wireless business. I mean, this has been their bread and butter for decades, so figuring out what's happening here is absolutely critical. Powermatic's main gig is providing wireless connectivity solutions. Think wireless modules, antennas. They've even had a long-standing relationship with the tech giant Qualcomm. So the big question is, what's behind an 18% drop in sales in such an established business? Is it a problem with the company itself? Or is there something bigger going on? Well, according to their own report, the reasons are mostly industry-wide. First off, the big switch to the new Wi-Fi 7 standard, it's happening a lot slower than everyone expected. A lot of their customers just recently spent a ton of money upgrading to Wi-Fi 6, and they're just not ready to do it all over again. On top of that, those same customers are sitting on a mountain of unsold inventory, so they just don't need to place new orders right now. It's a classic cyclical slowdown. But inside that slowdown, there's this really fascinating shift happening. Just look at this geographic breakdown. Sales to the USA and Europe have dropped off quite a bit as a percentage of their total business. But sales to Asia, they've more than doubled, jumping from 23% to a massive 48% of their total sales. The company says this is because their big customers in the US and Europe are now using manufacturers in Asia to build their stuff, to manage costs and tariffs. Powermatic is simply shipping their parts to where the factories are now located. Now, in the middle of all this talk about falling sales, here is a hugely important detail. The company's gross profit margin stayed incredibly stable at 48%. Just to be clear, gross profit margin is basically the profit they make on each individual product they sell, before you factor in overhead costs like marketing or R&D. The fact that it's holding steady means they haven't had to slash prices to get people to buy. It's a huge signal that their core technology is still really valuable, and it's a real sign of underlying health in the business. Okay, now for the plot twist. Let's move on to that second story, which is almost the complete opposite of the first. This is all about the company's massive new venture into property development. First things first, let's be super clear on what we're talking about here. When the report says development property, it doesn't mean they're just, renting out some extra office space. Nope. The financial statements show they're taking a property they already owned and completely redeveloping it into a multi-story food factory with the specific goal of selling off all the units. This is a totally different business from designing wireless tech. And this is no small side project either. As of September 2025, the company has this development valued on its books at over 16.6 million Singapore dollars. And that's up by more than 2 million in just 6 months, which reflects all the construction and marketing costs they're pouring into it. It's a major, major investment. So you might be thinking, if they're spending all this money on a huge project, why isn't it helping their profit numbers? Well, this slide breaks down the accounting reality. Right now, the project just shows up as a growing asset on their balance sheet. It doesn't actually count as revenue or profit yet. That comes later. The company says they'll start recognizing profits in the 2026 financial year, and it'll be based on how much of the construction is finished. So the big payoff is coming, it's not here yet. And here is a really, really savvy part of their strategy. While the project isn't generating profit yet, it is generating cash. This number, almost $8.2 million, is listed under something called contract liabilities. In simple terms, this is cash they've already collected from buyers as deposits for those factory units. So even while construction is going on, sales are already happening and cash is flowing into the company, which helps fund the rest of the project. Pretty smart. So this brings us to a really crucial question. To manage a slowdown in your main business while also funding a massive new one requires one thing above all else: financial strength. So let's check in on the company's overall financial health. This number is, well, it's staggering, frankly. Powermatic is sitting on over 63 million Singapore dollars in cash and bank balances. For a company that did about 6 million in revenue over 6 months, that is an enormous safety cushion. This pile of cash is the engine that lets them be patient with the tech business recovery and super ambitious with their property pivot. And if that wasn't enough, here's the other side of the coin. The company reports absolutely zero bank borrowings. No debt. Nothing. They don't owe any money to banks. They don't have interest payments to worry about. They are funding this entire transformation completely from their own resources. This is what you call a fortress balance sheet. So you see, this combination, massive cash reserves and zero debt, is the key that unlocks their entire strategy. It gives them the freedom to ride out a temporary dip in their main business while investing heavily in what's next, all without any outside financial pressure. Okay, so with one business slowing down and another one just getting started, what does the company itself say is coming next? Let's dive into their official outlook. The company gives us a dual outlook, and honestly, it's cautiously optimistic on both fronts. For the wireless business, they're starting to see a comeback. Customer interest in Wi-Fi 7 is picking up, and those old inventory levels are stabilizing, which means new orders should start flowing again. On the property side, the outlook is even more solid. They repeat that profit recognition will start in FY 2026, they've already sold a third of the units, and they even point to positive economic factors that could help future sales. But out of everything in their outlook, this quote right here is the most powerful. They explicitly state that the financial impact of the property development will be significant compared to the wireless connectivity business. Just think about that for a second. The company is literally telling its shareholders that this new venture, which they called not the core business, is expected to have a bigger financial impact than their entire original tech operation. That is a profound statement about where they see their future growth. And that leaves us with the ultimate question. That negative 27% profit drop, it wasn't just a sign of a struggling business. It was a snapshot of a company in the middle of a deep transformation. They're using the financial strength they built over decades in tech to fund this massive pivot into property. So the question isn't just about when the Wi-Fi market will recover anymore. It's about whether this huge property bet will pay off and potentially transform Powermatic from the tech company it has always been into something entirely new.